We're looking now at the mining sector on Open Exchange with the help of Stephen Meintjes. He's Head of Research at Imara S.P. Reid. Morning to you, Stephen. We want to talk about the global pullback in investment in mining, but let's start locally. And the front page story today, Business Day, oil and gas. We had the announcement the previous week. The minister saying he wants the oil and gas sector away from other exploration, mining and so on. He's also talked about certainty. So let's start with that oil and gas. Why is this important? Why has he separated it? What is it going to mean?
Well, I think he separated it because there were more controversial proposals in the oil and gas section, and the Chamber of Mines said it was happy with its side. So at least it gets that out of the way, and he can address the minerals and oil. But and it was mentioned in that report that there's a potential to buy 51% on top of the 20% free carry, and talk of extra royalties and BEE and so on. A lot of uncertainties there. But essentially, the whole thing is, it's like mining. It's a resource, and it can be addressed, as we've discussed before here, by something like the old gold mines formula tax, rolling that out to the whole of the mining, and for that matter, oil and gas industry, because you see, governments get a bit greedy, and you've just seen Rio Tinto saying to the Zimbabwe government that it might close down its diamond mine there as a result of increased royalties proposed and so on. So in boom times they get greedy, and then of course they suffer when mines close.
And the gold mine, it's a sliding scale. That's the point, isn't it?
It's a sliding scale, so they get a lot more tax in boom times, and then in recession times, obviously, it enables the margin mines to survive. And it actually preempts all these discussions about nationalization and windfall taxes and so on. It's a very simple mechanism.
Makes sense, yeah.
Stephen, what about the element of certainty? Because you've just mentioned nationalization. I was speaking to David, and he said it doesn't really matter what certainty they're talking about, because for certainty they just mean something that is favorable for the mining companies. There may be certainty in what they're saying, but it may not be favorable.
Well, that is right. You see, the beauty of the formula tax is, although the high margin producers will complain in good times when their tax rates go up, the fact of the matter is they understand the system and they can plan accordingly. So in that sense, you'll have certainty, not as regards the tax rate, unless you can forecast the commodity prices with 100% accuracy, but at least they understand the system, and it really preempts populist demands for nationalization and windfall taxes.
But more broadly, I mean, this thing about uncertainty has been going on for years.
Yes.
Is the South African government in a position to say, right, we're now going to set everything in stone forever? I don't think they can. We're still evolving in so many ways politically. Look at the land reform question. They closed land claims applications in 1998. Yes. They said, there's the line. Now it's reopened.
Yes. Well, again, that's the whole conversation about natural resource rentals. It even covers that those
Which is
areas.
what your book's about.
Yes, yes. So we would need a huge national conversation to really go the whole hog and do it right across the whole spectrum of the economy. But in mining, the way forward is relatively simple.
Let's talk about that way forward, Stephen, because we have been seeing a number of mining companies pulling back on their capital expenditure. Glencore, Anglo American is doing the same thing. Lonmin. This is the future.
Well, it's certainly this part of the cycle, and it's only natural. And I'm afraid, with the latest news out of China, when one reads about empty cities and so on, and steel consumption declining last year for the first time in many years, I'm afraid it's going to take some time before commodity demand can be reignited in China. So I think we've got a fairly dreary prospect of resource commodity prices for the next at least 6 months or so.
Of course, Mark Cutifani, I think, has probably captured it last year when he said, we're less interested at the moment in the long-term exploration, and we're putting some projects on hold. We're looking at getting value now.
Yes.
But you have to be careful with that, because it's a long cycle, but when that cycle moves and you find suddenly you would like to have a lot more copper coming out of the ground, but you didn't build a mine 10 years ago.
Well, that's absolutely right, and Billiton is doing exactly the same thing. They're conserving cash, curbing certainly all exploration, and expansion is pretty well off the board right now. I mean, all those expansions of last year in iron ore were based on decisions taken, several years ago in the boom. But this is typical of the cycle.
Yeah. I remember when Cynthia Carroll came in at Anglo American, they said, you missed big investments, you've got to catch up. So big investments, no, got into trouble with that a couple of years ago because the boom ended.
Yes.
Stephen, what about investment in diamonds? There was a note put out about a week ago regarding Investec wanting to increase their stake in Anglo American because of its exposure to diamonds. Well, the outlook for other commodities isn't looking great. Is the bright spark here diamonds?
Well, it's certainly a lot more stable than petroleum, for example. Billiton's got petroleum, Anglo's got platinum and diamonds, and certainly the outlook for both of those is looks a lot better than petroleum right now, despite the bounce we had in Brent in the last couple of days.
Well, we'll end our commodities discussion, our mining discussion there.